The views expressed in this podcast are not to be taken as either trading nor financial advice. Neither the announcer nor the Sirius Report make any claim to be certified financial advisors, and all reporting is dedicated solely towards being both informative and educational. Greetings, everyone. Good afternoon, and welcome to the Sirius Report Market Wrap-Up for Friday, November 1st, 2024. We're going to take a look at a lot of economic data, some from yesterday, some from today. The jobs report was important because it showed that the shenanigans that were being done from the BLS and the administration were definitely an attempt to try to influence the election. But the revisions proved that things are far worse than was reported. We're also going to take a look at why, one of the major reasons why the equity markets, the housing market, the derivatives market, and even perhaps a little bit in the paper, gold, and silver markets, why we've seen so many all-time highs. So with that in mind, let's go ahead and jump right in and see how the markets fared here at the end of the week. Well, everything was green in equities. Dow was up 288 points to regain the 42,000 handle, closing out at 42,052, while the S&P 500 was up 23.35 points to 5728, and the Nasdaq was up 144.77 points, closing out the week at 18,239. Now, here's what an important piece of information of why there's actually liquidity for influx into the equity markets. For anyone wondering why the stock market is bubbling higher, this comes from ShadowStat's 1025 subscriber update. Yesterday's release of the September 2024 money supply and related annual benchmark revisions showed U.S. systemic liquidity at an inflation-driving new 58-year peak. What I mean by that is that the Fed has created, the government has borrowed, and the banks have borrowed a record all-time, going back 58 years. So what is that? That's probably the late 1960s. Yeah, about the late 1960s. When we went off the silver standard and started using fiat currency, leading up to increasing the fiat currency use leading up to the closing of the gold window in 72. This is why there is so much liquidity sloshing around in financialization, i.e. the Wall Street level. None of it, or very little of it, is getting to the general economy, and instead is being used to buy stocks, to for like places like BlackRock to go and buy land in Ukraine and try to buy up assets on the cheap, knowing that the currency is probably in its final driving days. Take a look at the bond markets. Well, as I mentioned, the stock markets reached all-time high, but the bond markets are screaming the exact opposite. The 10-year ended the day up a full 10 basis points, closing out at 4.386, but earlier today had gotten as high as 4.4%. The 2-year is up to 4.212%, and the 20-year is just under 4.7%. So yields on the middle to long end of the curve are increasing. The expectation is that the Fed is going to give up on inflation, despite the fact that inflation is raging. Anything the Fed does, including increase rate or hike rates, which is something I doubt if they will do, unless Powell admits that he made the Arthur Burns mistake, we're going to see these rates continue to climb up while they cut rates to either keep the stock market going or to claim that they're trying to help the economy, but the general economy is already going down the toilet. In the dollar markets, well, because of what Treasury did, the fear of inflation, and what is going on in Europe, especially with a rumor, and I'm saying this as a rumor, is that overnight Russia cut off Gazprom cut off natural gas to Poland, and a few other places in Eastern Europe, because they had set a deadline for demand that all gas sales had to be done in rubles. And Europe, of course, delayed that. And eventually, when it was cut off, very quickly, they agreed to pay in rubles. So it looks like Russia won out on that. And now de-dollarization, especially in the energy market, continues to increase. This is possibly one of the reasons why the dollar was up 34 cents to close out on the DXY at 104.32. That and some news coming out of Japan, where they are not potentially going to raise rates, but they are going to see about doing some type of tightening, or at least no longer buying JGBs to try to, because the inflation is starting to rise in Japan, which could see a currency crisis like we had about 6 months ago. In the gold markets, well, gold and silver both did pretty good at the opening when they saw the jobs report, but once the COMEX opened, it was toast. They are desperately trying to let the banks cover their shorts, and this is a continuing, ongoing process, because the amount of naked shorts that the bullion banks and many of the hedge funds has is still immense. I mean, at one point, it was upwards of 550 naked short contracts for every ounce of silver, or equivalent contract of silver. But with that in mind, silver ended up the day down 19 cents, closing out at 32.52 after on Friday, last Friday, getting up to $35 an ounce in the December 2024 contracts. Meanwhile, gold was down $7.90, closing out the week at 27.36. In the crypto markets, cryptocurrency started out also in the green at the beginning of the day, but liquidity quickly left, and we have a mixed bag with Bitcoin and Ethereum. Bitcoin was down 1.8%, closing out the trading day at 68,951 after starting at 71,554, and Ethereum was down 0.75% to 24.97. In the oil markets, well, we had WTI get over $70 a barrel before it was a sell-off. Much of the liquidity was moved into equities, and that was done through the middle of the day. But WTI did end up in the plus 23 cents, closing out the week at 69.49. And Brent crude was up 21 cents, crossing over the $73 handle to 73.02. Okay, taking a look at some economic data. A shocker. October payrolls, huge miss as private jobs go negative for the first time since 2020. What do we mean by this? Well, there was a print. Let's see what the actual was. The monthly print of only 12,000 jobs. A huge drop from the pre-revision 254,000 that was done in October, and just 13,000 away from a negative print. But the key thing is that 28,000 private jobs were canceled, and the reason it was in the positive was because of the government jobs. So the government was the primary employer. Private is laying off hand over fist. And then, of course, we have the big news, the revisions. August jobs revised down by 81,000. September down or revised by 31,000. And then, of course, we have October. Let's see. Does it have the October revision? Oh, no, it doesn't have the October revision. Oh, yeah. September revision, when 818,000 jobs were removed. 7 of the past months have been revised lower. Yeah, so it doesn't have the October ones in the report. But nonetheless, the revisions are huge, and everything is built for the algos, who, when they see the headline number, they, of course, make their billions of trades per nanosecond. Not quite that, but exaggeration. And everything is hunky-dory, and Wall Street keeps doing what they're doing. Why? Because many in the administration, as well as the Congress, as well as the Fed, they all have stakes in the equity markets, and that's their way of getting rich. Moving over to manufacturing. U.S. manufacturing survey hit 16-month low, but prices paid spiked in October. Oh, inflation. Moments after the BLS reported the biggest drop in manufacturing jobs since the lockdowns, S&P Global reported its U.S. manufacturing PMI rose to 48.5 in October, still in contraction, but higher than the 47.3 in September. ISM manufacturing prices index spiked back higher in October as both new orders and employment remain in contraction. So, fewer orders, layoffs, but higher prices. That's known as stagflation. Well, an ugly report, according to the Peter Cheer of Academy Securities. Not only were 12,000 jobs created, all the jobs were in the public sector. That's what I mentioned before. But private payrolls dropped 28,000. Presumably the hurricane had effect, but why didn't the hurricane affect ADP the prior month when it came out at above estimates of 233,000? Point being is that more and more analysts are recognizing that the government numbers are absolutely false, manipulated, and politicized. Moving over to something from yesterday, initial jobless claims plunge to 6-month lows. With the impacts of the hurricanes wearing off, initial jobless claims plunged last week to 216,000, down from 228,000, the lowest since April. Most of these jobs that were retraced were in North Carolina and Florida. Continuing claims also fell from 1.88 million to 1.862 million, but remains near the high of December 22. That's not necessarily because people aren't applying for unemployment insurance. It's because they're falling off the rolls. And the last thing we're going to take a look at before the weekend, the Fed's favorite inflation indicator comes in hotter than expected. Go figure. Government handouts soar and savings slump. Fed's favorite inflation indicator, which is core PCE, printed hotter than expected, 2.7% versus 2.6%, and flat with August 2.7% rise. Headline PCE rose 0.2% month over month, which dragged down the year-over-year PCE, its lowest since February of 2021. On a month-over-month basis, PCE appears to be accelerating, with durable goods and services picking up, which ties into the manufacturing number I mentioned just a few moments ago about the survey hitting the biggest lows, but costs for those goods are rising. That's pretty much what inflation does. And finally, so-called super PCE, services minus shelter, i.e. rent, home, mortgages, etc., it rose 0.3% month over month, leaving the year-over-year carnage or change sticky at around 3.2%. So as you notice, we're making cuts even when we're beyond the Fed's 2% inflation benchmark. It doesn't matter. They understand the liquidity problem that's going on in the banks. Even though there is a massive amount of liquidity, when you take a look at the money markets, up near $6 to $7 trillion, most of that is already leveraged. It's collateral for what they've already bought. So they have to provide to the banks. And of course, this means that the Fed is going to maybe not lower rates next time, but with the repo market, which Paul and I talked about earlier this week, with the repo market pretty much almost completely done, the banks no longer holding treasuries, they're going to have to find some way to keep the can going down the road, and we'll see what they do in the FOMC next month. Anyway, I want to thank everybody as always for stopping by to get your market wrap up for Friday, November 1st, 2024. Thanks always to everybody here at the Sirius Report community for your support. Don't forget to subscribe, like, share, comment. Pass this on to anybody you think it might be important to. And of course, above all, have a great weekend.